Hello and welcome to episode 7 of the AAT Level 2 Introduction to Bookkeeping course from Quo Vadis Media Limited. This episode, episode 7, if you've listened to episode 6, is another one of our mini episodes looking at double entry. So it's a mini series within a series, really. And this is double entry 2 within that mini series. And this is about ledgers and the bank account, as promised within the last episode. And we're going to look a little bit at ledgers and a little bit at the bank account. And as we've mentioned in previous episodes, these early episodes are an introduction to some of these topics, and we're going to gradually open these things out as we learn more about them. This episode is specifically aimed at anyone who either is or who is thinking of studying the AAT Level 2 certificate in bookkeeping or the AAT Level 2 certificate in accounting. That's because both of those qualifications include this unit that we are looking at here, Introduction to Bookkeeping. That's what we're learning about at the moment. But then as we build on that knowledge, later on, we're going to be looking at principles of bookkeeping controls as well. So this episode, this mini episode, episode 7, double entry 2, ledgers in the bank account, we're going to answer 3 questions. We're going to look at what is a ledger, because students quite often get mixed up, particularly early days, about what a ledger is. How do they work? And we're just going to have a very brief introduction to that. And also, what is the bank account in a general ledger? We touched on the bank account a little bit in the last episode. We'll touch on it much more in future episodes, but we're just going to get a little introduction to how that works today and the rules that underpin it as part of double entry. So firstly, what is a ledger? Well, in your level 2 AAT studies, you're going to come across 3 different ledgers. You are going to come across the receivables ledger, the payables ledger, and the general ledger. A ledger is like a book. Historically, it was. Of course, this is bookkeeping. Originally, this was all done on paper and all done in books. And so the best way to think of the 3 different ledgers is to think of them like books. And each book is a collection of accounts collected by theme. So part of understanding double entry is understanding the theme. So the first one, the receivables ledger, the theme of this is that the receivables ledger is a collection of individual accounts, and each account is for one credit customer. Credit customers are people to whom the business sells on credit. So a bit like buy now, pay later from that point of view. And I'm simplifying here slightly, but imagine a book with 100 pages and every single page is a different credit customer to which the business sells on credit. And it records the fact that the sale has taken place and the fact that the customer owes them money, and it'll also record later on when the customer pays them as well. And we're going to dig much more into that in later episodes. The second ledger that we're going to look at is payables ledger. Very, very similar behavior to the receivables ledger. It's just swapped the other way around. So a payables ledger is a collection of individual accounts, credit suppliers, from which the business has bought on credit. So this different way round here. So business buys on credit. And again, imagine a book with 100 pages and every single one of those pages is a separate credit supplier from which the business has bought on credit. It records the fact that the purchase has taken place. It records the fact that the business owes money to that supplier, and it records when the business pays that supplier as well. So the receivables ledger and the payables ledger, both are ledgers which look at the idea of buy now, pay later transactions, what we tend to call in accounting credit transactions. And we're going to look a little bit more again in the future lesson at a cash and credit transaction when we look at the receivables and payables ledger. But just hold that in your mind now, that the receivables ledger and the payables ledger are for credit transactions. The receivables ledger for credit customers, to which the business has sold on credit, payables ledger, credit suppliers from which the business has bought on credit. But remember, each ledger is not an account, it is a collection of accounts collected together by theme. And then the third ledger that we have, which here in AAT we call the general ledger. It's sometimes called the nominal ledger. Sage, if memory serves me right, accounting software, still calls that the general ledger. General ledger, by the way, the name of it is more general. So it's a collection of individual accounts for a variety of different types of transactions within the business, covering a range of different transactions, often numerically arranged in categories. So we looked in the last lesson at dead click and deep click and pearls. We looked at expenses, we looked at assets, we looked at drawings, we looked at liability, we looked at income, we looked at capital, we looked at purchases. That was our dead click and deep click. In terms of pearls, we also looked at running expenses, liabilities, and sales. These are all the more general transactions, and these will be in the general ledger. So these will be in the general ledger. So for example, if you are recording your telephone bill, you're recording that you've paid your telephone company, that will be in the general ledger in both the telephone expenses account, like we looked at in the last lesson, because expenses accounts will be in the general ledger, but also the bank account, which we're going to look at in a moment. The bank account is either an asset or a liability account, depending on whether you have money or depending on whether you are overdrawn, but that will appear in the general ledger. So a general ledger has a much wider range of different accounts, and often they're in categories, especially in computerized accounting within the general ledger. So all the assets might be together, for example, all the liabilities might be together, all the expenses might be together, all the income might be together, etc., to make it easier to find them. In computerized accounting, it's perfectly possible to sort the general ledger by in alphabetical order, so the first letter of the account name. But in older traditional, they were quite often gathered together by category. But the general ledger, unlike the receivables ledger and the payables ledger, has a number of different categories in assets and expense, income and liabilities, capital and drawings, etc., etc. So for the rest of this short lesson, and I'm trying to keep these lessons fairly short, trying to do lots of short videos rather than a few long ones, so you can just take in little bits of topic at a time. We'll just introduce ourselves to the bank account. Now, we saw the bank account very briefly in the last episode, and we saw this little image that we've got here. Bank account 1200. 1200 is just general ledger coding, by the way. The bank account doesn't have to be 1200 in general ledger coding, but in a lot of systems it is. It has a debit side and it has a credit side. Now, significantly here, the bank account that I am talking about here, and I've deliberately used capital B, capital A, because whenever you see me say bank account with a capital B, capital A, I'm talking about the account in the general ledger. So it's a record for the business of the transactions that are taking place in its bank account. So if you are a business, you will get a bank statement or you'll get access to online banking. So the bank will keep you in touch with what's going on in your bank account anyway. But that's from their perspective, and that's really important. And we'll come to that in a moment. You will have in your general ledger, in your records, your own separate record of the bank account, which will be an account called a bank account in the general ledger. Now, we'll see much later in episodes, there are actually different ways of looking at this, even within AAT level 2. And actually, the bank account might be just part of something larger called the cash book, which we will look at later. That's much more complex, much more detailed in some ways. But we're just keeping it simple at the beginning by imagining that we just have an account called the bank account in the general ledger. And it's from the perspective of the business. That's a really important point. And if that doesn't make sense now, it is. And we'll see why as we go through. So for the bank account in the general ledger, it follows the following rule, and this is part of double entry bookkeeping. So money paid into the bank account in the general ledger. So money coming into the business and going into the bank account, and therefore increasing the balance, or if the account is overdrawn, reducing the liability, will be recorded on the debit side of the account. Money paid out of the bank account. So we saw example in the last lesson, I think it was telephone expenses and rent potentially in the general ledger. So money leaving the business will be recorded on the credit side of the account. Now, lots of people, particularly adults, older students who've had lots of bank accounts and lots of bank statements in their life, get confused by this because it seems to them the opposite of everything that they've ever seen in their bank account and in their bank statement. Because quite often on the bank statement, credit is money in and debit is money out. Now, it's not that the bank statement is wrong. It's that the bank statement is from the bank's point of view. The bank account in the general ledger is from the business's point of view. So if, for example, you are putting money in the bank, and I'm going to use the first transaction here. On this bank account we've got here, we have on the 1st of January, capital of £20,000. Imagine that this is the first entry that a business is putting into its bank account. So the owner is putting money into the bank. So the owner puts £20,000 into the bank. That business now has £20,000 in the bank, an asset of £20,000. Now we're talking from the business's perspective here. That's going to be, as we have here, a debit entry for £20,000. Bank account is an asset account if you have money in the bank. We looked at in the last lesson when we looked at dead click and deep click that asset accounts have debit balances. So from the business's perspective, the business has £20,000 in the bank. From the bank's perspective, the bank owes £20,000 to the business. The bank actually has a liability. It's holding this money on the business's behalf, which means that the bank has the liability of owing that money back to the business when the business wants to take it out of the bank. So the business's asset is the bank's liability if the business has money in the bank. The business's liability is the bank's asset if the business doesn't have money in the bank. If I, for example, on my personal bank account, I was overdrawn by £1,500, etc., I have a liability. I owe £1,500 to the bank. However, the bank is owed £1,500 by me. The bank has an asset. So that is the difference in perspectives there. And that's the reason why what seems like a debit and a credit for bank statements that you may well have seen is the opposite when we look at the general ledger, which is from our perspective, the business perspective. Perspective is hugely important in double entry in terms of what side things are on. So we've just got a couple of transactions here just to show the idea. So as I've already said, on the 1st of January, the owner has put £20,000 worth of capital into the bank. So now the bank balance has a debit balance of £20,000. Also, the business has taken out a bank loan that day, 1st of January, of £25,000, which has come into the bank. Now, bank loan, I'll just talk about a little bit, but I'm sure we'll come across this in a later episode. Bank loans often confuse people because bank loans are an asset and a liability at the same time. But in the bank account, it's an asset because you have that money in the bank. In the bank loan account, which isn't shown here, it's a liability because you owe that money back. But that's part of what is in double entry. Again, we'll look at a little bit later on in other lessons, what's called the dual effect. Every sum of money is doing two things at once. And it's a matter of what is it doing in this account at this time. In this account, the bank loan is behaving as an asset because it's increasing the balance of the bank. On the same day, the business has spent money. 1st of January, they spent £15,000 on machinery. That is money which is leaving the bank. They are spending that money. So £15,000 on machinery spent out of the bank, say, for example, by debit card or bank transfer. We don't know here, it doesn't matter. Money paid out of the bank account is recorded on the credit side. It's reducing the asset. It's reducing the amount of money in the bank. It's reducing the value of the bank account. So it's a credit. And then finally, this business as well, they've bought some raw materials on the same day, 1st of January, raw materials, £13,500. Again, they've paid it out of the bank account. We're presuming here for machinery and raw materials that the business hasn't bought these goods on credit. They've paid straight away. Just for ease of understanding these transactions as much as anything. So £13,500 has gone out of the bank account. That £13,500 has reduced the value of the bank account. It's reduced the asset. It's reduced the balance of the bank account. It's money out, so it's a credit there. So that's just 4 transactions, 2 debits, money coming in, 2 credits, money going out, which show what's going on in the bank account in the general ledger. Talked about the bank account here, but the same rules apply to similar accounts. So if the business has a bank deposit or a savings account, then this money in as a debit, money out as a credit will also apply. It's following the same rules. I talked about the cash book earlier. When we look at the cash book in later episodes, this same rule applies. Or if the business just has a cash account, exactly the same rule will apply. Also, if the business has a petty cash book, again, we'll look at that in later episodes, or a petty cash account, the same rules will apply. These are all considered from a bookkeeping point of view. These are all considered to be either bank accounts or cash accounts. And they all follow exactly the same principle. Money in is a debit, money out is a credit. They are asset accounts if they have debit balances, liability of the accounts if they have credit balances. Petty cash or a cash account cannot have a credit balance. You can't have minus cash. Think about it, you can't have a minus £10 note. It just doesn't work, does it? But bank accounts can be debit or credit because of the possibility of overdrawn. Bank deposit or savings account, they can't be overdrawn. But a bank current account, and mostly what I've been talking about here is a bank current account, but most of this still applies here. So that's the end of this episode. We're going to build on some of that knowledge in the next episode. More information, do please subscribe and like our YouTube videos. It's really great to see that our subscriber list is growing. Visit our website, quovardimusmedia.co.uk, where you can find a little bit more information about us. And because you're probably an AAT student, there are product pages for each of our major books as well, with information about those and links to where you can buy them as well, either in print, which is how most people buy our books, or also in Kindle as well. You can also follow us, and please do, on X, on Facebook, on Instagram, on Blue Sky, and on LinkedIn as well. And whenever there's a new episode of these videos, then they are announced through those platforms as well. You can find us just by searching for Quo Vadis Media Limited, and we'd be really happy to see you over there and get to know you as well. Tell us what you're studying. That would be really useful, how you're finding it, what you're struggling with, what you're enjoying. Other than that, that is the end of this episode, and we look forward to seeing you in the next episode. That'll be double entry 3. Not telling you what it is yet, keep a bit of a sense of mystery, but it will be episode 8 overall of this series. For now, goodbye.